If you've been following the news recently, you've probably heard stories about raw material shortages or the global shortage in computer chips. Now, it may not be a topic that keeps you up at night, but it's really important to understand. It's not just a topic for Wall Street investors, but for normal people like you and me, because high inflation rates can lower our standard of living. Now, at its worst, it could wipe out our entire lifetime savings that we worked so hard to get. In this video, I'm going to cover what's going on right now and some investment strategies that you could apply to protect your savings. First, let's cover inflation. Inflation refers to a general increase in the prices of goods and services. Basically, your money buys you less stuff. You have to pay more for this same bread, diaper, car, or whatever it may be. Now, this is nothing new. Prices have always been rising, right? And that's true, of course. For a long time, it's been around 2% per year. Hopefully, at the same time, your salary increased by the same rate or more. Now, this way, your purchasing power stayed the same and all is well. But that's not what's going on right now. To get a better picture of the scale, let's look at some charts. A year ago, 1,000 board feet of lumber cost about $400. Now it's above $1,400. That's an increase of 250% in 1 year. The price for 1 ton of aluminum was about $1,500. Now it's about $2,500, an increase of 67%. The crude oil price doubled in the same time span. I'm sure you noticed the increase at the gas pump. Copper, steel, iron ore, and so on, the same picture. So there is a fundamental pressure on raw materials. And of course, when raw material prices increase, prices for the final products increase as well. Housing and cars are going to be more expensive, but also companies like Procter & Gamble, Clorox, and Coca-Cola already announced price increases for their products. This affects everyone. So what's going on there? Well, some of it is because of the global pandemic. As we're coming out of lockdowns, demand spikes. Factories were shut down and are slow to get back to normal production levels. The traffic jam in the Suez Canal, caused by a giant container ship that was stuck for 6 days, didn't help either. 12% of the global trade passes through the canal, and something like this results in months of supply chain disruption. Now, we could expect this to resolve itself and balance out over time, but unfortunately, that's just part of the story. Governments around the world had to fight the consequences of COVID. They provided relief payments to businesses, families, and workers, securing loans, providing tax reliefs, and so on. In the US, another $1.9 trillion relief bill was signed into law. With the already existing bills, that's a total of $5.3 trillion. $5.3 trillion. That's a crazy number. And that's just the USA alone. Now, of course, all this money has to come from somewhere. And so the federal banks around the world started printing money at a huge scale. To that, legendary investor Charlie Munger said, "I'm so afraid of a democracy getting the idea that you can just print money to solve all problems." And he went on to say, at the end, if you print too much, you end up in something like Venezuela. He was referring to Venezuela's hyperinflation, which at the end of 2018 was estimated to be at a shocking rate of 80,000%. That's of course an extreme example, but flooding markets with cash definitely has consequences. With all the stimulus, more money in circulation, people have money in their pockets and they're willing to spend it. In April, the US saw the consumer price inflation unexpectedly jump to 4.2%, from an average of 2% over the last years. Now, the Federal Reserve called these price increases transitory. But then how do they know? They've been wrong before when they said in 2007 that the subprime mess is grave but largely contained. Now, we all know what happened afterwards. Inflation is a complex process, and psychology has a lot to do with it. When we as consumers see rising prices, we'll probably end up buying more now, because tomorrow everything may be more expensive. Demand grows, and as a result, prices go up. But it could be that after the summer, we're going to be back to normal. Nobody knows. But many experts are afraid of coming inflation rates, similar to what we had in the 70s. Now, back then, the US had double-digit inflation. It was blamed on oil prices, but in reality, it was due to excessive growth in money supply. Very similar to what's going on right now. So better be prepared for inflation. Let's cover some of the strategies that I'm applying that you may find helpful. Obviously, always consider your own personal situation and get professional advice if you need to. Number 1, cash is trash. The worst thing you can do in a situation of high inflation is to hold cash, because by keeping cash, you can buy less and less with it every day. Now, same goes for fixed interest bonds. Generally, central banks raise interest rates to fight inflation. So when they do that, bonds that are fixed at a lower interest rate will be less valuable because you could buy a bond with higher interest return. Number 2, value stocks. One of the greatest investors of all time, Warren Buffett, explained how to invest in stocks during times of high inflation. Our acquisition preferences run toward businesses that generate cash, not those that consume it. He goes on to say that high earning numbers are nice, but not if such pretty numbers can't be converted to cash. So investments in established companies with high cash flow generation tend to perform better than growth stocks that burn cash in the hopes of high profits in the future. Number 3, real estate. Real estate investments are often seen as inflation hedge investments, meaning that in the past, their value increased more or at least at the same rate as inflation. If you're renting out your property, you can create cash flow from rental income. And if you manage to secure a fixed loan on your property, your payments to the bank remain the same while the value of the property will increase with inflation. But you don't actually have to go out and buy, manage, or finance real estate property. An alternative could also be to put some money in a REIT, which is short for Real Estate Investment Trust. This way you can invest in portfolios of real estate assets and you're going to get a share of the income that's produced. Number 4, gold. In times of uncertainty, investors often turn to gold as a hedge against unforeseen disasters. But some say it's silly to invest in gold because it doesn't have any intrinsic value. And sure, like with any currency, it only has value because we as a society decide that it does. But this noble metal had served for thousands of years as currency, and its price has been increasing constantly over time. And just like real estate, it's a finite resource, and at some point, there will be nothing more to mine. So to put some money into physical gold or through an exchange-traded fund may be a good idea. Number 5, cryptocurrencies. And personally, I don't invest in cryptocurrencies, but they could also protect against inflation because of limited supply. For example, there can only be a maximum of 21 million Bitcoins. It's not like money where central banks can just turn on the printing machine. It's a currency that can't be watered down. But of course, it's a huge gamble because their history is too short and the rates are fluctuating a lot. And we don't really know what a sustainable level is. So that wraps up some investment strategies that you might want to consider during these times. Inflation plays an important role in our economy. It affects everyone's finances. So I hope this video was helpful for you to understand what's going on right now and why it's important to pay attention to these developments. If you enjoyed it, please give it a thumbs up and consider joining our community by subscribing if you haven't already done so. Many thanks for watching, and I'm going to see you in the next video.